Imagine deciding to invest your savings and walking into the stock market for the first time. It feels a lot like stepping into a massive, colorful candy store. There are thousands of options and no idea where to start. In this store, every individual jar of candy on the shelf represents a single company's stock. You could just pick one flavor, say a tech company, and buy a whole bag of it. But there is a major catch. If you put all your money into one single flavor and it turns out to be a bad batch, your entire investment takes a hit. Relying on one company is risky. To stay safe, the logical move is to diversify. You'd want to buy just one piece of candy from the top 50 jars. But doing that yourself is incredibly difficult. As you add each individual stock to your cart, the total cost quickly skyrockets. Buying shares of 50 different companies requires huge upfront cash. Plus, tracking the daily performance of all of them is too expensive and exhausting to manage. Fortunately, you don't have to shop this way. At the checkout counter, you'll find two popular pre-packaged solutions designed to solve this exact problem: the mutual fund and the ETF. Both options let you buy a diversified piece of the whole market in one go, without draining your bank account or requiring you to manage a portfolio full-time. Let's look at the mutual fund first. Think of it as a custom-curated sampler box of candies. A team of professional managers acts like a chef, hand-picking specific stocks for this box. For their expertise, they charge a management fee. Also, you cannot know the exact price when you buy during the day. It's calculated just once, after the market closes. This setup limits your control. If big financial news breaks at noon, you can't buy or sell your mutual fund instantly to react to it. You have to wait until the end of the day to see what your trade actually cost. A mutual fund gives you the safety of a diversified basket, but you pay a premium for that human curation, and you give up the ability to trade quickly. That brings us to the second option, the exchange-traded fund, or ETF. Instead of being hand-picked by a chef, an ETF is pre-packed automatically to mirror a specific market index, like the top 50 companies. Because a computer algorithm is doing the packing instead of a highly paid human manager, the cost to run an ETF is incredibly low. This means you keep much more of your own returns over time. And the most useful feature of an ETF is how easily you can trade it. It functions exactly like a single share of a company on the stock market. It has a live price tag that updates constantly throughout the day. If the market shifts in the morning, you can buy or sell it instantly, giving you total control over your money while the sun is still up. Anyone with a standard investing account can buy into an ETF. You can start small, purchasing just one single unit of the fund. An ETF combines the broad, safe diversification of a mutual fund with the low cost and real-time freedom of a single stock. But if thousands of people are buying and selling these boxes all day, how does the price of the box stay perfectly matched to the actual value of the 50 candies inside? How do we know the price on the shelf is actually honest? The secret is a hidden wholesale system. While we shop in the front, there is a back row, the primary market, keeping prices accurate. Here, authorized participants act as wholesale partners dealing in truckloads. To make more boxes, they gather individual candies, give them to the fund maker, and receive new ETF units. This is a constant balancing act. If the box on the shelf gets too expensive, these wholesalers build new ones in the back room for cheaper and bring them to the floor, which naturally pushes the price back down. If the box is too cheap, they buy them up and break them back down into individual candies to sell those instead. Because these big players are constantly working in the background to make a tiny profit on these price differences, they keep the price on the shelf perfectly accurate for you. This unique structure is exactly why you can trust the price you see on your screen. Let's bring it back to the checkout counter of our candy store. You have a choice to make. We can compare these three core ways to invest by risk, trading speed, and cost. Single stocks offer instant trading and no fees, but carry high risk. Mutual funds lower risk through diversification, but restrict you to delayed end-of-day trading with higher fees. The exchange-traded fund lowers risk with a diversified basket, lets you trade instantly, and operates with a very low fee. With those facts laid out, the overwhelming candy store makes perfect sense. You can confidently grab your basket and walk out. For new investors seeking steady, diversified growth without taking on extreme risk or paying excessive fees, the ETF is the smartest starting point.